Hi, my name is Mark Seymour, Portfolio Manager of the Northstar Income Fund, and this is an update for the third quarter 2024. Over the quarter, the portfolio performed really well, outperforming its cash plus benchmark by quite a wide margin. And this came about as a function of very favorable performance drivers. Going into the second quarter, we had the election results, a positive outcome there. And with that, or since then, we've had improving growth metrics. We've also had an improvement in terms of energy supply. And along with that, you've had moderating inflation, which has afforded central banks to start embarking on an interest rate cutting cycle. So all those factors coming together really driving asset prices and good performance. At the start of the quarter, our portfolio was really nicely positioned on a modified duration of 3, which is at the upper end of our risk band. And during the quarter, we saw a nice rally in bonds with yields at the 10-year point going from above 11% all the way down to just below 10%. With our fair value at 10.5%. What we did do over that quarter was to reduce our exposure to fixed bonds and start allocating that to inflation bonds at the front end of the curve on real yields of 4.5%. So that's been the dynamic of the portfolio during the quarter. As we currently stand, valuations are still very attractive, so bond yields have come back a bit. At the midpoint, or at least at the 10-year point, yields at approximately 10.5%, which is fair. And you've found very attractive yields with your inflation bonds at the front end of the curve. You've got interest rates that are moderating. So the relative values, we believe, has shifted away from cash-like instruments, so your floating rate notes. And so where that leaves us currently is a portfolio that's nicely well diversified. So around about 15% in floating rate notes. We've got a large exposure to inflation bonds, 45%. Around about 25% in fixed bonds, so that's slightly reduced from a quarter ago. And then outside of that, in terms of balancing the risks, at the moment, the globe is facing heightened geopolitical risks. And with that, even though we're quite positive on the rand, we do believe that it's prudent to hold some offshore exposure. And as a result, we've got 7% offshore holdings, predominantly US Treasuries, short-dated. But in the last couple of weeks, we have been extending duration as those valuations have improved. So we've seen a little sell-off in US Treasuries, and the 10-year yield just above 4% starts looking quite attractive. So as we currently stand, the portfolio is very, very nicely positioned for a low-risk investor seeking an inflation plus 2 return.